All right. Today is Tuesday, June 22nd. This is a recap for the stock market activities today. I'll tell you what, states are reopening, including this deadbeat state. And more people are coming out and about doing their business. But there is one element that perhaps you noticed in your own neck of the wood, which is the pent up anger, not pent up demand. The pent up anger and nastiness that people have toward each others. As if we've been locked up for a year or so, and now we're coming out once again, and we have no idea how to deal with others. For example, today I went out to the grocery store, walking, and people are honking and screaming at each other's. Fights all over the place, people screaming at me, "Hey, watch out where you're going. What are you, blind?" As if I stepped out in Grand Theft Auto, and now I appreciate the isolation during the pandemic. But anyhow, I went to the grocery store, and I bought a few eggs and a tub of ice cream, which shrank, by the way, in size. Shrinkflation. But magically the price actually went higher, not lower. Anyways, this is a show about financial markets, not about my life. So let's get to it already. The main events of the day. Number one, the crypto crash, which was averted for now, keyword for now, because Bitcoin violated the very important critical level of 30,000 and looked really ugly in the morning. But whoever or whatever entity it is managed to rescue cryptos, and Bitcoin closed above 30,000 once again. But the technical damage has been already done. And all in all, the crypto crash in Bitcoin wiped off an excess of $1.3 trillion. We have $1.3 trillion worth of bags being held right now by bag holders, hodling for the moon. And perhaps the most dangerous phenomena in Bitcoin specifically is leverage. And once we crack below 30,000 and close below 30,000, that might trigger the tsunami of selling, and leverage might become front and center when that tsunami of selling takes place. But I know what you say. FUD, bro. Stop it with the FUD. What's with the FUD? What's going on? Boomer, bear. I got some good news for you. I have an ally for you, and that is Tom Lee from Neptune. Because Tom Lee still sees Bitcoin at $100,000 a pop. And of course, it looks like Tom Lee from Neptune has become homeless. He's now doing interviews from his car, perhaps losing a lot of money from the crash of Bitcoin. But rest assured, your favorite analyst still sees Bitcoin at $100,000 a piece someday. And of course, unfortunately, we have some newbies in the stock market who joined during the March bottom of last year. And they worship this guy, Tom Lee, believing that he's the most accurate analyst out there and a genius, the messiah, because he said that stocks only go up in a bull market. Even my 12-year nephew called it that stocks will only go up in a hyper bubble mania market. But I already did an expose about this guy, and I will post the link in the comments, where we went back all the way to the financial crisis, and I showed you all the calls of Tom Lee, and they're as good as throwing a dart in the dark. The guy is pretty much a fortune teller, and he made a mess out of himself because he's been sticking to the so-called epicenter stocks, saying that his best call is oil stocks. But last week, when we saw treasury yields crashing down, all of a sudden Tom Lee came out and said, we better go back to the NASDAQ, but also keep the epicenter stocks. What a genius. Buy everything, and something gotta work. Throw the spaghetti on the wall, something gotta stick. Buy everything, every stock out there, and you're gonna hit something. And now that yields are normalizing again and rallying higher, not recovering all the losses, by the way, but yet popping higher once again, Tom Lee's confused as hell. And of course, calling market rallies and stocks gonna go up during a hyper bubble mania is the easiest thing out there. Even my dog is calling for the S&P 500 to go higher. But the real superstars are the ones who make the contrarian calls, who call the crash, time the crash, and bet on the crash while the stock in a hyper mania bubble territory, when everybody is indulged and complacent. Superstars like Michael Burry, George Soros, Tudor Johns, Jeremy Grantham, all of these people made their calls and bet against the market, and they made their names in history. These are the people we remember, not Tom Lee and these clowns who call the obvious. In 10 years, no one is going to remember Tom Lee, but we're going to remember whoever is going to call this upcoming crash and time it and bet on it accurately. Could it be Michael Burry again? 2 for 2? We'll see. But enough with this clown Tom Lee. Let's move on to another main event that we got today. A piece of data regarding home sales. And while sales were down due to the lack of inventory, prices continue to climb higher. Now, when home sales are down, aka economic activities are down, but prices continue to linger and climb higher, isn't this a recipe for stagflation? But I know. Too early to say. Papa Jerome says it's going to be transitory. You're just doing FUD, bro. But prices, these are home sales prices, by the way, risen in the fastest pace in history. And now the median home price in the United States is at $350,000. And by the way, I challenge you to find a decent home for $350,000. Maybe an Amazon box that somebody left on the street, that's worth $350,000. But a decent home will cost you at least $500,000. And the mania is shifting from the housing market to the rental market. And now we're seeing rents skyrocketing higher across the country, to the tune of sometimes the rent costs more than the mortgage. And people are still paying for that. Absolute mania. Divorced from any rationale, and as if 2006 and 2007 didn't happen at all. Maybe these people weren't alive back then, I don't know. Yet with all of this mania, the Federal Reserve remains in denial. We have Fed zombies, the likes of Mr. from the Cleveland Fed, saying perhaps it is not time to taper yet, and we have to wait till fall. And when fall comes, we have to wait till winter. And when winter comes, we have to wait till the summer. And when summer comes, we have to wait for infinity and beyond. Because our job is not really normalizing prices, stabilizing prices, or unemployment. Our job is prop up reserve and inflate the assets of the wealthy, stocks and real estate. And here is the third main event of the day, which is Jerome Powell's testimony in Washington, D.C. with the clowns over there. We continue to hear from members of Congress and the Senate and Jerome Powell himself that inflation is transitory. They continue to repeat and parrot this bullshit narrative over and over and over again. And by the way, I did some digging for you. I went deep. And people pay for this shit, but I'm providing you this information for free. Here's an article in the New York Times, February 1970, just to illustrate for you that this bullshit narrative of transitory was also touted back during the great inflation of the 1970s. The headline reads, "Inflation hurts and stopping inflation hurts." And this is by Edwin Dale Jr. He's probably dead now, but who cares? And the article was published February 22nd, 1970. Now, let's move to the digital version so we can read this crap. Here it is. It is true, of course, that wage costs already built into the economy will continue to exert upward pressure on prices, and that bargain wage settlements will be large again this year. This is one of the chief reasons why all sides agree that inflation cannot be stopped quickly. Even the high interest rates that have accompanied inflation and the effort to slow it are a cost element for some industries, notably public utilities, whose capital investment requirements and hence borrowing requirements are high relative to labor and materials costs. The huge increase in prices of most metals in 1969 is another built-in element that will tend to work its way through to prices. Still, here comes the but. The historical record is clear. If demand is reduced and government follows a policy of restraint for a reasonable length of time, prices will eventually stabilize. We have not had perpetual inflation in the United States in the post-war period, contrary to popular belief, and there is no reason why the present dangerous inflation should prove permanent, despite the forces working to keep rising prices. Spoiler alert, inflation was not transitory, and continued throughout the 1970s, creating the worst inflation crisis in the modern history of the United States. Whether it is under a Democrat or Republican, Nixon, Ford, Carter, inflation continued to rise higher and higher and higher. I guess you could say it was transitory. It only lasted a little over a decade, and then it went away. These geniuses at the Federal Reserve and the likes think of inflation as a Snapchat story. It lasts for a little while, and then it goes away. Or shall we say herpes? It pops a little while, you feel a little itch, and then it goes away. Don't worry about it. It's not contagious. But the best part of Powell's testimony in D.C. today was his interaction with this moron called Jim Jordan. And Jim Jordan started pretty good, with facts and a reasonable argument. But then he drifted into the $300 a week. Oh, that's the problem. This is what we have to eradicate first to tackle inflation. Watch.
The chair now recognizes Mr. Jordan for 5 minutes.
Thank you, Mr. Chair. Chairman Powell, the Fed has two mandates, right?
Maximum employment and stable prices.
Maximum employment and stable prices. It seems like both got some problems today. I want to spend a little time on the first. Why are the jobs numbers so bad right now?
Well, I think we're digging out of a very deep hole. We've made a lot of progress, but I would agree with you. We have a long way to go.
Over 9 million job openings. Over the past 2 months, only 800,000 jobs added back. That's pretty bad. Is there a specific reason you point to as why those numbers aren't where we would, frankly, hope they would be?
You know, it's a good question, and my thinking is that there are some temporary factors that are weighing on job creation, and I mentioned those earlier. Another thing is actual hiring is at very high levels, but it's being offset by high levels of quits and retirements. So the net, what's happening is that the net job creation has been lower, but actual hiring is high. And that's, in a sense, quits is a good thing because people are looking for jobs that they want more. Retirements are just something that happens.
What about unemployment benefits? Does that factor in as well?
It may be a factor, you know, and it'll be a temporary one because something like 15 million people will see either those benefits disappear or significantly decrease.
My understanding is the state unemployment plus the federal enhancements, $37,000 a year. Might that discourage people from going back to work?
You know, we're going to find out. We're going to find out because it's going to be gone really quickly.
I think we are finding out. You add in the stimulus package, child tax credit, family of four, it's about $110,000. I mean, every single employer, literally every single employer I talk to in our district, and frankly, employers I talk to around the country tell me they can't find people to work. And you think it's more of quitting and retirements, or is it more unemployment, or a combination, or what is it?
I think in terms of things that are weighing on people getting in the labor force, I think it's those three things I mentioned. It's still some people are still afraid of COVID. Maybe they're living with someone who's vulnerable. It's also schools are closed still, and having schools be open again will free up a lot of caretakers. I think unemployment benefits too. I think if you would expect a significant, a really strong set of jobs numbers coming up beginning in the next month.
Didn't you expect higher numbers? Didn't you expect higher numbers in April and May?
Yeah, I did.
Which, I mean, it sort of surprised me. I guess when you pay people not to work, you shouldn't be surprised when you don't have workers. I've never seen a situation like this where we now have, as the ranking member mentioned, we now have several governors, 25 I believe, who've turned back. We said we don't want the federal enhancement to unemployment. I've never seen that. I've been in politics 26 years. I've never seen governors turn down federal money. So I think that just underscores how serious the problem is. But you said you think it changes soon?
Well, we know that these benefits run out on the federal ones.
What if the Democrats renew them, which they're talking about doing?
Excuse me?
What if the Democrats renew them? That'd be a problem, wouldn't it?
Again, I don't comment on legislation.
No, but you said you expect it to run out and that will help. I'm asking you, that's not what Democrats are saying. They're talking about renewing them. And if so, if it helps if they run out, if they renew them, won't that hurt?
Well, these are judgments for people who stand for
No, I'm just following your logic. You said if it runs out, that will help the employment situation. I mean, I got employers.
I think we'll see strong job creation in the fall. I really do, and I think there are all these, as you point out, 9.3 million job openings, many millions of people unemployed. There seems to be some kind of a speed limit. It may just be that it's hard to match up with a new job, and people feel like they can wait a little bit longer and really shop carefully.
It seems to me, Chairman, and again, I know you don't talk, you're not going to comment on policies, but I don't know if the Democrats are doing anything right. They kept the economy locked down. They're spending money like crazy, proposing more, I think a $6 trillion budget the White House is proposing, all causing inflation. Inflation's went up the last 4 months, continues to increase. As we said, you got two mandates at the Fed, stable employment, low inflation. We got unstable employment, we got high inflation. And now they're paying people not to work, and that may continue. And then finally, on top of all that, they're thinking about raising taxes. I mean, this is amazing to me. First, you pay people not to work, and then the folks who are working, you're going to raise their taxes, and somehow they think that's going to help our economy, when, as I said now a couple times, every single employer I talk to tells me they can't find people to work. What do you think about all these policy ideas from the Democrats?
Again, it's not my job.
No, but your job is stable employment and low inflation. Right now we have 9 million job openings and inflation that's went up 5 months in a row. So something has to give. I'm not necessarily blaming you. I'm blaming the Democrat policies.
And of course, I felt bad for Papa Jerome here, for a little while at least, because it's not his fault. He's not giving $300 a week. And by the way, let's talk about that, the $300 a week, because Wall Street is coming for you $300 a week. God forbid you make a little more. God forbid you relax a little bit and you stay at home and you get paid $300 a week. They're coming after you. What Jim Jordan doesn't understand is it's not about the $300 a week. You moron. Because we have jobs offering 20 to 25 bucks an hour. Ask yourself a question. Would you rather work 40 hours a week at 25 bucks or 20 bucks and make $800 plus bonuses, plus benefits, etc.? Or, oh my God, I'm sitting like a king here at home, cashing 300 bucks a week. Ooh, rich baby, 300 bucks a week. Does anybody need more than 300 bucks a week? Give me a break. The 300 bucks a week has nothing to do at all with the fact that employers are having a tough time to fill jobs. Perhaps in certain instances here and there, but to blame it all on the 300 bucks a week is absolute bullshit. We have a paradigm shift among the way employees are thinking right now. On one hand, you have technology which enabled the new generation, the Gen Zers and the likes, to find alternative ways to make an income. Whether it is OnlyFans, whether it is Twitch, Roblox, YouTube, TikTok, it doesn't matter. Find me a teenager girl or any young woman in her 20s who started OnlyFans making thousands of dollars a week, not a month, and tell that person to quit OnlyFans and go back and work at McDonald's. Not gonna happen. Furthermore, a lot of Americans are quitting their jobs. They're fed up, we're overworked and undercompensated. Matter of fact, Americans are the most overworked and undercompensated in the developed world. God forbid we take a break and take our time to get back in the lines of corporate slavery. God forbid we take our time and stay at home for a little bit and cash in 300 bucks a week. God forbid they have to come after us. God forbid we demand wages that keeps up with inflation. They have to come after us. And of course, Wall Street is scrambling right now and panicking and demanding from their servants over at Washington, D.C. to eliminate the 300 bucks a week and incentivize workers to join the workforce right now, this moment. Because if us workers wait and demand higher wages, guess what? Wages will go higher. Incentives will go higher. We will see the phenomena of wage inflation. And this is exactly what Wall Street, the Federal Reserve, and the owner class in this country doesn't want to see, because wage inflation is permanent, not transitory. If a company, an employer, offers you 25 bucks an hour instead of 15, they're not going to come out later and say, we're sorry, we're going to go back and reduce your wages to 15 bucks an hour because inflation was transitory. So here's the strategy for America's workers. We need to have diamond hands and huddle until wages go to the moon, bro. If we do not stampede and take these jobs right now, wages will continue to go higher. Incentives will continue to go higher. And then, when the time is appropriate, we go out and take these jobs, locking in the higher wages. And if the Fed is right that inflation is transitory, then at some point, real estate prices, car prices, grocery store prices, gas prices will all go down, but we will lock in the higher wages. And finally, Americans might have a decent standard of living. And this is exactly what Wall Street doesn't want. They want obedient workers. Obedient workers. And this is the reason behind this war they're launching against the $300 a week that people under unemployment are getting right now. Their claim is that the emergency is over. COVID-19 is receding, it's gone. Why keep these emergency measures of giving people $300 a week? Let me ask you a question, because a lot of you, unfortunately, pretty much lost your minds. You became corporate defenders, hoping that someday that will trickle down to you and you will become rich too and join the 1%. Honey baby, it's a big club and you and I are not in it. It is an invitation only club, but some are too delusional to believe that that is possible. Ask yourself a question. The Federal Reserve, leading the monetary policy of this country, has been goosing up Wall Street with emergency measures of quantitative easing since the financial crisis in 2008. We know that the quote-unquote emergency is over now. These measures were enacted to recover the economy and the stock market after the financial crisis of 2008-2009. Yet these emergency measures are still here. For example, the housing market is on fire. I just gave you the facts. The highest prices and the fastest rate of increase in prices ever. Yet the Federal Reserve continues to buy billions and billions of dollars every month in mortgage-backed securities. Why? Why are they continuing to buy mortgage-backed securities when we have one of the hottest markets ever in real estate history? But I know the $300 a week, that's the real problem. You want to cut the $300 a week for us deadbeats? Fine. Then start cutting the $120 billion a month the Fed is using to goose up Wall Street via bond purchasing and mortgage-backed securities purchases. I know what you're going to say. Bro, you sound like a socialist. You Marxist. You know what? If telling the truth makes me a socialist, have at it. Anyhow, these videos are supposed to be limited to market information and technical analysis. And my commentary regarding the economy and the markets should be in the headlines of the day segment instead. But again, I'm doing this part-time and it is very time-consuming. And I'm finding it very difficult to produce more videos, even though I have a lot of videos for you, a lot of topics that I want to discuss. For example, the Mark Cuban situation with the Titan coin, Elon Musk, the housing mania, and I have all of these videos prepared for you under the headlines of the day segment. I'm going to do my best to attempt to produce those for you in a timely manner. With that being said, let's go back to the market and see how we close today. And here we go. The Dow Industrial Average closing in the green by 68.61 points, or a gain of 0.20%. The Nasdaq leading the day by 111.79 points, or a gain of 0.79%. The S&P 500 closing in the green by 21.65 points, or a gain of 0.51%. The Nasdaq is leading today, but watch out what's under the hood. Watch out for the macroeconomics data we're about to receive tomorrow and throughout the week, because that will have implications regarding yields. And if yields spike higher, perhaps the Nasdaq will lose its leadership. What about the sector's performance today? Leading the pack at number 1, capturing the gold medal, technology. At number 2 for the silver, consumer cyclicals. At number 3 for the bronze, communication services. Meanwhile, the laggards of the day led by utilities, real estate, and healthcare. And here it is, under the hood, the advance to decline ratio, NYSE 50% advancing versus 47% declining. The Nasdaq, the pretty boy, the leader of the day, actually not looking so good, under the hood. 43% advancing versus 54% declining. What does that say? It tells us that the rally in the Nasdaq was primarily done by the big cap technology names: Apple, Microsoft, Facebook, Google, Netflix, etc. Moving on to futures. What's going on with crude oil? Closing at the flat line for both the WTI and Brent. No movement here at all. What about softs? We talked about the housing data we got in the morning that impacted lumber prices negatively. The question remains, will home builders use the drop in lumber prices to restart their building projects, adding more supply in the housing market? And would that create downward pressure on home prices and we see some air getting out of the bubble? And when that happens, the $1 million question is the following. Will the mania restart? Is the demand still here? Is it just aggregate demand waiting for better prices? Or have potential home buyers migrated to the rental market and already settled there and now they're not interested in buying homes anymore? Because if that is the case, then home prices will continue to dwindle. And if you add to that the increase in mortgage rates, perhaps we will see a soft crash in the housing market. But if the mania restarts because the demand at alternative prices, in this case lower, brings back home buyers into the market, then we will see the bubble resuming once again, growing larger and larger and larger. And that will pave the way for the hard crash scenario. Back to futures, we saw some declines here for sugar and coffee futures. Meanwhile, gains, sizable ones for OJ, squeezing higher. Meanwhile, modest gains for both cotton and coca futures, or shall we say cocoa futures. For you who made a big deal out of it, coca, cocoa, who cares? They're both addicting. What about metals? The US dollar continued to decline today, specifically after the comments from Jay Powell, yet that did not help gold and silver prices to rally higher. So is gold predicting that yields or the US dollar is about to pop higher again? That remains to be seen, because copper got the message and rallied higher. Copper looking at the US dollar's decline and getting the green light to rally higher. Likewise, we saw gains for platinum futures. However, palladium futures declined slightly. What about meats? Big gains of about 2% apiece for both live and feeder cattle futures. Meanwhile, lean hogs bouncing from the losses of yesterday just slightly by about 0.5 percentage point or so. The technical damage in the lean hogs chart has been already done. There was a steep positive trend for lean hogs, and now it has been broken. Doesn't mean that lean hogs entered bearish territory, but it means that the best of the gains are perhaps behind us. What about grains? We have a mixed picture, but mostly declines, led by corn, soybean meal, soybeans, wheat, and canola. Even though the US dollar declined slightly, that did not help corn or soybeans prices. However, we saw gains for rough rice futures, massive gains of over 3%, and then modest gains for both oats and soybean oil futures. Moving on to the big casino, the options market. What's going on here? Leading the tables, Apple by about 1.3 million contracts today. About 75% of those were calls. And then we have AMC with about 880,000 contracts. About 64% of those were calls. Once again, the volume is receding here for AMC. Even though the stock closed in the green today, this is not good for AMC. Now I will show you the critical level that the apes must keep for AMC by tomorrow during the charts analysis. And then we have Tesla, the souffle, with about 700,000 contracts. About 44% of those were calls. So interestingly, we're seeing more bearish bets against the souffle, not bullish bets. What's also interesting today is the rise of other meme stocks. Perhaps that is impacting AMC negatively. We have Clover, we have Wish, and now we have Plug Power, and another name, ATOS, also joining the mania with elevated options volumes specifically for calls. And pay attention here, because this week will be extremely critical for meme stocks. And the reason is the upcoming Russell rebalancing on Friday. We'll talk about that in a little bit. What about the unusual activities taking place in the casino today? Starting with the ticker SPY. We continue to see these insurance bets for some reason. A lot of nervousness invaded the market after last week when we saw yields crashing, the SPY falling off the sky. Now all of a sudden money managers and fund managers are buying insurance. In this case, they're buying the 330 puts, expiration date July 30th. With expectations that the SPY will drop over 22% by then. They paid about 40 cents a piece to enter this trade. All in all, bringing the total to about $850,000. And again, these bets are way out of the money. What does that say? It says that these fund managers are riding the wave on massive gains. They're only insuring their funds if the S&P 500 crashes by the tune of over 22%. That tells me that these funds are sitting on massive gains, which is a warning signal, by the way. When you see institutionals sitting on massive gains but not taking profits at all, it's a sign of extreme greed. What about the ticker HIMX? This is for HIMAX, and this is yet another EV bet. It was a bad trading session for the name today, down by over 6% or so, and somebody's betting for more pain to come by buying the $12 puts, expiration date August 20th, with the expectations that the name will drop by over 9% by then, and they paid about $1 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker JWN? This is for Nordstrom. They're buying the 37.5 calls, expiration date August 20th, with expectations the name will rise by over 9% by then. They paid about $1.65 a piece to enter this trade. All in all, bringing the total to about $1.5 million. What about the trade for the ticker FCX, Freeport McMoRan? And this is interesting because either it is a bet against the inflationary trade, and what we saw yesterday was a dead cat bounce for names like Freeport, Caterpillar, Deere, etc. Or it could be an insurance trade for somebody who bought the stock earlier. And it is not a bad insurance trade, by the way. I would have followed this one, but I already bought an insurance policy for my Freeport shares a few weeks ago. But here it is, they're buying the 32 puts, expiration date September 17th, with expectations that FCX will drop by over 13% by then. And they paid about $1.30 a piece to enter this trade. All in all, bringing the total to about $1 million. And this is a smart hedging strategy, by the way. It gives you coverage all the way till September if the stock falls by more than 13%. What about the trade for the ticker IWM? And this is important, by the way. We're seeing increasing bets against the IWM. That could be a bet against the reopening trade. It could be a bet against meme stocks, but it is more likely a bet for extreme volatility this upcoming Friday due to the Russell rebalancing. We will talk about the rebalancing more as we get closer to Friday. But understand this. For now, meme stocks, specifically AMC, is the largest component of the IWM, the Russell 2000 index. That doesn't make sense at all. And it is dangerous for the IWM to keep AMC as the largest weighting. But the rebalancing will happen for both the Russell 2000 and the Russell 1000. Names that migrate from one exchange to the other will be bought and sold. And again, we will talk about this issue in details as we get closer to Friday. We saw bearish bets against the IWM by the tune of over $9 million. And here we have another one, perhaps a lot smaller, but still sizable. They are buying the 203 puts, expiration date August 20th, with expectations that the name will drop by over 11% by then. They paid about $1.80 a piece to enter this trade. All in all, bringing the total to about $1.2 million. Continuing with interesting trades, what about the trade for the ticker Triple Qs, the NASDAQ? Everybody's having an orgasm today because the NASDAQ reached all-time highs. But somebody's making a contrarian bet here, or perhaps an insurance policy. Either way, they are seeing some trouble ahead for the NASDAQ. And they are buying the 294 puts, expiration date September 17th, with expectations that the NASDAQ will drop by over 15.5% by then, and they paid about $2.60 a piece to enter this trade. All in all, bringing the total to about $1.2 million. Lastly, what about the trade for the ticker FDX? FedEx. They're making a bullish bet here by buying the 330 calls, expiration date August 20th, with expectations that the name will rise by over 10.5% by then, and they paid about $5 a piece to enter this trade. All in all, bringing the total to about $2 million. Moving on to the heat map analysis. Right away, you're seeing that the inflationary trade holding steady here. We're seeing mixed picture, but mostly gains for financials, industrials, energy, and materials. Likewise, we're still seeing gains in the technology sector and even the deflationary trade today, sort of like the tide lifting all boats. We have no news whatsoever today beside home sales, but as we continue to move forward throughout the week, we will get more macro data that could have implications one way or the other on the market. But the main driver for the gains in the Nasdaq today were the big cap technology names. Apple, Microsoft, Facebook, Google, even Amazon joining the rally today. And here's the other component of FANG, which is Netflix rallying significantly higher today on Spielberg optimism. What is he going to do? Resurrect the 90s? And they probably paid him hundreds of millions of dollars. This is not good for Netflix. They need to be more efficient with the money. The new generation of viewers doesn't even know who Spielberg is. The rally in tech today was more inclusive than yesterday. You saw the value names holding steady, but you also saw the growth names, the high multiple names in the software and the likes also joining the rally. And making headlines today, Microsoft, because it reached the 2 trillion market cap milestone. Now, Microsoft happens to be one of the few names in the tech sector that I own in my portfolio. The others are Fortinet, the ticker FTNT, and McAfee, MCFE. But that's about it. This is my exposure to tech. And if you guys remember, the old subscribers, we used to do the earnings reviews, and I detailed my reasoning behind buying Microsoft, that it is the best play among cloud stocks, even better than Alibaba. And that has been proven to be the correct decision because Microsoft outperformed the rest of the cloud names. Stick to the fundamentals and you'll do just fine. What about the themes analysis? Starting with the reopening trade. You have a mixed picture here. Some losses, some gains, indecision one way or the other. Fund managers are not abandoning the reopening trade altogether. They're still holding. Some are taking profits. Some are seeing the dips as an opportunity to buy. But there is no conclusive conviction one way or the other. What about the inflationary stocks? Likewise, mixed picture, but mostly in the green. We're still seeing some dip buying in names like Freeport, CarMax, UPS, John Deere, Hubbell, Alcoa, all with sizable gains today. The real test is, how will the yield curve react when we get more macro data? Because that will have implications regarding the inflationary stocks. What about the low rates trade? Again, we have a mixed picture, but mostly in the green, specifically for the high multiple names. Whether we're talking about Okta, Zoom, Nvidia, Dash, Peloton, up big today because they have some subscription service. Who cares? It's a bike company. If you want to talk about the future, the new generation is not interested in sitting at home and biking. They want to go to the gym, do squats, and have the Instagram stories, calling themselves fitness models, yada, yada. But until then, the mania goes on. And as we expected from yesterday's video, today will be one of those days where the tide lifts all boats. We don't have any more news, at least for today, so the path of least resistance is higher. Whether it is for the inflationary, disinflationary, NASDAQ, Dow, S&P, Russell, doesn't matter. The path of least resistance is higher until we get to the heart of the week, where we're going to get more data and we'll see how the reaction would shape up to be. We'll talk more during the conclusion of this video. But for now, we're moving on to cover charts, starting with the SPY 30 minutes chart. The test for today was 422. The SPY managed to close the gap, consolidate for a little while, building that energy, and it did more than that by closing and reclaiming above the resistance level, now support of 423. The move is getting a little overextended here, and we saw a flush by the end of the day in the SPY. However, not closing below 423. So it is hard to make a bearish call here. The SPY will go down to 422 or perhaps 420 because for now, the energy has been unleashed to the upside. We saw the coil being pulled back last Friday, and that was a bear trap because it sprung back all the way to reclaim 423. 423. So long as the inflationary trade is back in the clear, yields are normalizing again, the SPY will do just fine. But the moment we get more talk again about tapering and the taper tantrum starts to resume, the question will become, how will the inflationary trade react to another episode of the taper tantrum? If the reaction is negative, then the SPY will reverse to the downside. For now, it is hard to make this call. What about the daily chart for the continuous contract? Once again, closing above the resistance level of 4,232. What does that mean? The sky is the limit, and the RSI is recovering from the negative divergence. But the MACD indicator, which is a lagging indicator by the way, has still not recovered. Is that good? Is that bad? For now, looking at the chart and the behavior, the very sharp reversal to the upside, one could not make a bearish call on the SPY. Yes, it did not close above all-time highs, but it managed to close above the very important level of 4,232 until we see a reversal and closing below 4,232 once again, and the RSI curls back to negative divergence. The chart remains bullish. What about the Qs? The Nasdaq 30 minutes chart closing at all-time highs. The RSI is getting overextended from a 30 minutes perspective, so we could see a pullback here, just slightly, perhaps all the way to 346 or even all the way to 344.5. The resistance, now support, that wouldn't be bad either. But for now, the Nasdaq remains healthy technical wise. And the reason is, amidst all of this uncertainty, a lot of fund managers are migrating to the big cap technology names, the Apples, the Microsoft, Facebook, Google, looking for safety until the dust clears regarding the taper tantrum. They want to see how yields behave. The massive, sharp downside move in yields incentivized some of these fund managers to migrate not to the mania names in tech, not to the software names, but to the safety of the big cap technology names, Apple, Microsoft, Google, and Facebook. If that changes for some reason, for example, we get hot macroeconomics data tomorrow or throughout the week, and yields decide to pop higher, then perhaps they will dump the Nasdaq again and re-migrate back to the re-inflationary trade. What about the daily chart for the continuous contract of the Nasdaq? Once again, healthy, positive divergence for both the MACD and RSI indicators. Even though the RSI is getting a little overextended, it is not overly overextended, it is not in overbought, quote-unquote overbought territory, so the Nasdaq, from a technical perspective, still has room to go higher. We're at all-time highs. That means that the sky is the limit. And if you are following the technicals, you wait for the chart to show you the next resistance level. What about the IWM 30 minutes chart? We talked about 227. This is the gap. The chart flushed lower just by a little bit in the first 30 minutes of the day, but recovering right away and knocking back and forth at 227. That particular behavior was an indicator that the IWM is thinking about going higher, not lower. And by the end of the day, we saw the IWM popping higher, closing above 227. Now what? We have the 228 to 229 zone. Notice the triple reaction from that zone before. It was support 3 times at least in the past, which means that this zone will act as resistance this time around. And remember, the IWM has a massive rebalancing coming up on Friday. That includes meme stocks. So be careful here betting one way or the other, whether it is for or against the IWM. Because my expectations are that we will see a massive move in the IWM one way or the other, depending on how the rebalancing will happen. We still have a few days to go before we get to Friday, but we'll keep an eye on the IWM's chart, and specifically one of the main components, AMC. If that stock stalls and doesn't break above 60 and 65, perhaps that will be a sign for trouble for the IWM. What about the Dixie, the dollar index? We talked about the overbought conditions, the extended conditions in the RSI indicator. That resulted in a pullback for the Dixie, and now we're trading below 92. Not by a lot, but just a little bit. It is too early to say that the tantrum is over, because the tantrum will be over once the Dixie trades below 91. For now, for all you know, the Dixie is just hovering back and forth at the level of 92, readying for another rally higher. And therefore, we have to watch how gold behaves, because gold is usually a leading indicator to what's about to happen in the dollar index. Powell, of course, went over DC and tried to retract some of the hawkish stance from last week, and we're seeing the dollar index pulling back. But other Fed members perhaps not following the same playbook. For example, we had Daly of the San Francisco Fed, and she went out and said that yes, perhaps tapering will happen a little sooner than expectations. Not exactly these words, but the message is clear. The Federal Reserve is divided. We have the Powell camp who's not thinking, and then we have the Kaplan, Bullard, perhaps Daly camp who are actually thinking about. And until that is resolved, until the Fed is unanimous one way or the other, the market will remain in a confused state. And here it is. What about gold? Bouncing from the Fibonacci retracement level. But the bounce appears to be a little weaker here, stalling. What is gold trying to say? Because the US dollar declined further down today. It should have been a green light for gold to continue to bounce a little higher. But is gold being too cautious here, saying watch out, the tantrum is not over, and perhaps the Dixie will pop higher again if we see another Fed member opening their mouth and saying, yeah, perhaps we should start tapering soon. The irony here is that the chart of gold is behaving exactly, at least right now, with the inflationary stocks, the likes of Caterpillar and Freeport-McMoran. Gold usually behaved in the opposite direction of the inflationary stocks and treasury yields. So this is a peculiar behavior from gold. We're trying to decode the message. And here it is. What about yields? For now, the possibility of an ABC pattern breakout above 1.5 and perhaps reaching 1.55 basis points is still possible. If the chart starts to violate 1.45 basis points, melting downward, then the ABC pattern will go out of the window. And perhaps we have lower lows here. That all depends whether the tantrum is over or not. We will know that for sure the moment we receive more macroeconomics data. And we will start to do that by tomorrow. We'll talk more during the conclusion of this video. But for now, looking at this chart, if you're betting one way or the other, the bet should be that yields will pop to the upside until and unless 145 is violated. What about the VIX? We had a positive trend line, not a steep one, a very tame, shy one, and we saw the massive divergence higher, only to be pulled down back to the trend line and now overdoing the pullback. The move higher was overdone, so the move lower will be overdone. The question is, will the VIX stabilize and reclaim the trend line, or are we about to see more declines? The behavior of the VIX tomorrow will be extremely important. If the VIX reclaims the trend line, then watch out here because the VIX will give it another shot at the level of 20. And that means that the SPY could pull back and do a 180. And that means that perhaps yields will go down and the tantrum is not over. We're trying to connect the dots here all together. What about Apple, the big kahuna, trading well above 131 on its way to reclaim 135 for support once again. For now, the chart looks positive, bullish. The problem is that this move has been ongoing by very low volume. And the reason for any skepticism here is that the path of least resistance during low volume is higher. And now the fund managers are migrating to the big cap technology names for safety until the picture regarding the tantrum is clear. It's no wonder why that Apple is rising higher. But what happens if that sentiment from fund managers start to shift for whatever reason, and we see the volume elevating once again? Could Apple reverse? That is the million-dollar question. But for now, the assumption is Apple will be able to reach 135 and react from that point. The chart remains bullish. What about Tesla, the souffle? Not doing a lot today, but still knocking over and over and over at 629. For now, the chart remains bullish. But perhaps the most important move that Tesla made today is not reacting to the massive decline of Bitcoin. Bitcoin trading below 30,000 at some point throughout the day, Tesla remained stable. And that is a checkpoint on the scoreboard for Tesla bulls, that Tesla did not react negatively to the sharp downward move in BTC. Am I going to bet against this chart right now? Of course not. Not until 540 is violated. What about Caterpillar? Reacting the same way as the chart of gold. We saw a massive pop higher yesterday, but now the move, the pop, the rebound, whatever you want to call it, is stalling. Is that all there is for the rebound in Caterpillar and the inflationary trade? The answer is no, at least for now. If the Fibonacci level of 210 is violated, then we'll know that the bounce is short-lived and we have more declines, not just for Caterpillar, but for the entirety of the inflationary trade. So watching this level of 210 is extremely important. For now, the assumption is the rebound should resume higher because Caterpillar is at oversold territory. And here it is, the chart of the day, the tulip, Bitcoin. What's going on here? The good news is that the 30,000 critical level was defended aggressively by the cryptomaniacs, or some entity, whatever that is. Regardless, it shows that there is energy to defend the 30,000 support line. But diving below that number, regardless of the recovery, is a warning signal that it is pierceable and the defense line could last for a day, perhaps two. But if the downward negative energy continues in BTC, at some point something gotta let go. And the defense line around 30,000 will break and we will see the floodgates opening for BTC. Watch the momentum indicators, the RSI and the MACD. They're not doing so good for now, and the bears still have the advantage in this chart. Now, some of you commented and said, we want to see the weekly and monthly chart perspective for BTC. What do you see? And by the way, I read all of your comments, the good, the bad, the ugly. Don't think that I'm ignoring you, and I want to make a video answering all of your questions, but once again, where is the time? But here it is, the weekly chart for BTC. By this point, you're aware of the mainstream perspective of the head and shoulder formation. It is clear and it is negative. It's not a bullish sign, it's a bearish sign. But understand that a head and shoulder formation doesn't mean that a crash is about to happen. It just means that there is a downward move imminent. I'll give you another example. Here is the chart of Peloton. We saw the same head and shoulder formation. This is a weekly chart, by the way. It resulted in a downward move by the tune of about 38%. Now, this is a big move, but it is not a crash. And the chart is now recovering once again. So could Bitcoin go down another 10, 15, even 20% as a result from the head and shoulder formation and then recover again? Yes, it is a possibility. It doesn't mean that Bitcoin has to crash all the way to 10,000 or 5,000. A head and shoulder formation is dreaded, but it is not a death sentence. What about the monthly chart? You want to talk about a death sentence? Here it is. The monthly chart is way overextended and there is significant technical damage in the chart. Watch the MACD indicator, for example. At some point, this indicator has to revert back to the mean, meaning zero. The current reading is over 10,000, meaning that at some point, when the reversion to the mean happens in the MACD indicator, meaning the momentum indicator, BTC will drop significantly lower, perhaps all the way to 10,000. This is the mean for now, going all the way to 10,000. And this is the call I'm making. But this is a monthly chart, mind you. Bitcoin could hold on for month or month or month. But at some point, it's going to go down all the way to 10,000 once again. Is it going to happen this month, next month, a year from now? That's up for grabs. But the reversion to the mean will happen 100%. And here is my rescue plan for Bitcoin. Pay attention here. Laser beams. All the laser beams in the world. Pay attention. Remember this article I showed you in the futures market coverage regarding powering crypto via cow manure? Perhaps this massive slide lower in BTC is making all of these laser beams shitting their pants. What if the laser beams can power cryptos, specifically BTC, via human manure as they shit their pants watching the chart of Bitcoin? That will be a self-sustainable business, isn't it? Clean energy. Come on. And that will make Reverend Elon Musk happy if BTC is powered via laser beams manure. And then he'll go back in BTC, tweet about it, invest in it, and there we go, back to the moon, baby. This is my rescue plan for Bitcoin. Lastly, what about the apes? AMC, what's going on here? Going back and forth between the range of 52 and 65. For now, we don't have a conclusive evidence one way or the other that the breakout will happen to the upside or the downside, but the options volume is concerning. It is receding, and that paves the way for a reverse gamma squeeze. Here's what you need to know. This is the options grid for expiration Friday. The highest open interest is at the 60 calls with about 24,000 open interest. Now, what the apes want to do is push AMC higher above 60 by tomorrow. It has to happen tomorrow. And then market makers will scramble to buy the stock because if it closes above 60 by Friday, they're going to have to buy the stock at the current price and deliver it to those who want to exercise their options. Now, market makers don't want to be in that position, so they start buying the stock ahead of time, aka the gamma squeeze. But they have another option. If the stock is struggling to break above 60 by tomorrow, if they have enough shares of AMC, they will start dumping their current shares to prevent the price to reach above 60 by Friday. And therefore, those call options expire worthless without the obligations to deliver for these market makers. So watch out for the level of 60 here. Tomorrow will be a critical day for AMC. And remember, either way, whether it closes above 60 or below 60, we have the Russell rebalancing on Friday. AMC has the highest weighting in the Russell 2000. This is a problem. It has to be addressed. The problem is that the rebalancing, the deadline for the rebalancing was last month, when AMC was not the highest weighting in the IWM. So the likelihood either way, AMC will not be migrating from the Russell 2000 to the Russell 1000, meaning that the Russell 2000 will be stuck with AMC, meaning will the Russell 2000 and the holders of the Russell 2000 dump AMC to reduce that weighting? That is the $1 million question. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the flash PMI, manufacturing and services indices, and we have new home sales. We got existing home sales today, but the new home sales number is even more important, specifically for forecasters of the housing market. So tomorrow we will start to get some juicy macroeconomics data with perhaps some implications on yields and the market as a whole. And again, I will be watching for the headline number, the flash PMI, but most importantly, prices paid. What about prices? Are they holding? Are they dropping? Are they increasing? Because that will be important regarding tapering. And if the number is too hot, then the tapering conversation will become front and center once again. And the problem here is, if the number is too hot and the market is now determined that tapering will happen a lot sooner, and we have a confirmation, whether the Fed wants to confirm it or not, tapering will happen sooner than expectations if the number comes out too hot. Now, will the reaction of the market be another tantrum, a resumption of the tantrum, or yields go down in fear of the tapering, or will the market revert to before last Wednesday, when every time we got a hot number regarding inflation, yields actually moved higher? Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.